They tell you that a market crash is an accident. They call it a black swan, a rare, unpredictable event that no one could have foreseen. When the Great Crash of 1929 destroyed the wealth of a generation, they blamed it on panic. When the dot-com bubble burst in 2000, they blamed it on overenthusiasm. When the global financial system nearly died in 2008, they blamed it on a few greedy bankers and bad mortgages. They are lying to you. Financial crashes are not accidents. They are not random acts of God. They are the mathematical inevitability of a system designed to push debt beyond the breaking point. If you study history closely, not the version in the textbooks, but the version in the ledgers and the data, you realize that every single collapse follows the exact same script. The characters change. The technology changes. But the pattern never does. There are 3 specific warning signs, 3 precursors, that appear before every major financial disaster in modern history. These signs are flashing right now. We live in a world where stability is an illusion. We are told that central banks have tamed the business cycle. We are told that modern financial engineering has eliminated risk. But 70 years ago, an economist named Hyman Minsky discovered a terrifying truth. Stability is actually what kills the economy. He proved that the longer things stay quiet, the more dangerous they become. Welcome to the Financial Coin Historian. Today, we are going to deconstruct the anatomy of a crash. We will travel from the tulip fields of 17th century Holland to the boardrooms of Lehman Brothers. We will examine the Minsky moment and the transition to Ponzi Finance. We will look at the massive mountain of margin debt that signaled the end of the Roaring Twenties. This is not about fear. This is about recognition. Because the system is repeating the cycle again. The debt is higher, the speculation is wilder, and the denial is deeper. This is the story of what always happens before a market crash. To understand why markets crash, we have to unlearn standard economics. Standard economics teaches that markets seek equilibrium, balance. But history shows that markets actually seek excess. The man who understood this best was Hyman Minsky. For decades, he was ignored by the mainstream. But in 2008, as the world collapsed, everyone suddenly remembered his name. Minsky's financial instability hypothesis is the key to unlocking the pattern. The paradox of tranquility. Minsky's core insight was simple but profound. Stability breeds instability. Imagine a period of economic peace. Businesses are profitable. People have jobs. Debts are being paid. In this environment, banks feel safe lending money. Borrowers feel safe taking on debt. Because things are stable, people start to take risks. They borrow a little more to expand the factory. They borrow a little more to buy a bigger house. This success validates the risk, so they borrow even more. Over a prolonged period of good times, the entire economy shifts from being conservative to being reckless. The very stability of the system encourages the behavior that will eventually destroy it. The 3 stages of debt Minsky categorized this evolution into 3 distinct stages. Understanding where we are in this cycle is the most important thing you can do as an investor. Stage 1, hedge finance. This happens right after a crash. Everyone is scared. Banks are strict. Borrowers only take loans if they can pay back both the interest and the principal from their cash flow. The system is safe, robust, and boring. This is the 1950s in America. Stage 2, speculative finance. As confidence grows, we enter the second phase. Borrowers take on more debt. They can pay the interest from their income, but they cannot pay the principal. They have to roll over the debt, borrowing new money to pay off the old money. This works as long as the economy keeps growing and interest rates stay low, and the system becomes fragile. This is the 1990s or early 2000s. Stage 3, Ponzi Finance. This is the terminal phase. This is where the bubble forms. In Ponzi Finance, borrowers cannot pay the principal or the interest from their income. They are borrowing just to pay the interest on previous debts. They are betting everything on the asset price going up. They believe they can sell the house, the stock, or the business for a higher price later to pay off the loan. The entire system becomes a pyramid scheme. It relies on infinite rising prices. If asset prices stop rising, even for a moment, the Ponzi borrower collapses. And because the system is interconnected, their collapse brings down the speculative borrowers, which eventually hurts the hedge borrowers. The Minsky moment. This collapse is called the Minsky moment. It is the instant when the illusion breaks. It is the moment when investors realize that the debt cannot be paid, and everyone rushes for the exit at the same time. Liquidity evaporates, prices freefall, and the stability that everyone trusted turns into a black hole. We saw this in 1929. We saw this in 2008. And if you look at the corporate debt levels and government deficits of today, you have to ask, have we entered the Ponzi stage again? Theory is useful, but history provides the proof. The first invariable precondition for a systemic crash is excessive leverage. A crash doesn't happen just because stocks are expensive. It happens because those stocks were bought with borrowed money. Leverage creates a forced seller. If you buy a stock with cash and it drops 50%, you can wait. If you buy it with debt and it drops 10%, you get a margin call. You must sell. This forced selling drives prices down further, triggering more margin calls. It is a feedback loop of destruction. 1929, the margin bubble. Let's look at the roaring 20s. It was a time of technological marvels: radio, automobiles, electrification. The Dow Jones Industrial Average rose sixfold in 8 years. But beneath the surface, it was a house of cards built on margin debt. In the 1920s, you could buy stocks with 10% down. If you had $100, you could buy $1,000 worth of stock. Brokerage loans, money lent to investors to gamble, skyrocketed. This was what Minsky called pyramiding. As stocks went up, people used their paper profits as collateral to borrow more money to buy more stocks. By 1929, margin debt was growing twice as fast as the market itself. The smart money was borrowing from corporations to lend to speculators. The system was soaked in debt. When the market twitched in October 1929, the margin calls went out. There was no liquidity. The pyramiding reversed into anti-pyramiding. The crash wasn't just a change in sentiment, it was a mechanical liquidation of debt. 2008, the shadow leverage. Fast forward to 2008. The mechanism had changed, but the principle was identical. Instead of stock margin, it was housing leverage. People were buying homes with zero down payments. They were taking teaser rate mortgages, where they didn't even pay the full interest. Negative amortization. This was textbook Ponzi Finance. The borrower depended entirely on the house price rising to refinance the debt before the teaser rate expired. But the leverage wasn't just with the homeowners, it was inside the banks. Investment banks like Lehman Brothers were leveraged 30 to 1. That means for every dollar of their own money, they had borrowed $30 to bet on mortgage-backed securities. A 3% drop in asset values would wipe out their entire equity. And when house prices stopped rising, just stopped, not even crashed, the Ponzi dynamics unraveled. Subprime borrowers couldn't refinance. They defaulted. The banks holding the debt realized they were insolvent. The leverage turned a correction into a catastrophe. The signal today. What does this signal look like today? Look at global debt, $300 trillion. Look at margin debt levels. Look at shadow banking, unregulated lenders who fund risky bets. Look at governments borrowing trillions to pay interest on previous debt. The leverage is no longer just in the stock market or the housing market. It is in the sovereign debt market itself. The entire system is now in the Ponzi phase. Leverage loads the gun, but valuation pulls the trigger. The second precursor is extreme asset overvaluation. Before every crash, prices detach from reality. But human beings are rationalizing animals. We don't just say, I am overpaying. We invent a story to justify why the price is actually correct. We invent a new paradigm. The Shiller PE ratio economist Robert Shiller developed the CAPE ratio, cyclically adjusted price to earnings, to measure this. Historically, the S&P 500 trades at about 16 times earnings. Before the 1929 crash, it hit 30. Before the 2000 dot-com crash, it hit 44. When prices go this high, the market is priced for perfection. Any bad news, any small shock, can shatter the illusion. The dot-com delusion, 2000. The dot-com bubble is the perfect example of valuation insanity. In the late 1990s, the internet was changing the world. That was true. But investors took that truth and extrapolated it to infinity. Companies with no profits, no revenue, and sometimes no product were valued at billions. Investors stopped looking at price to earnings and started inventing new metrics like price to clicks or price to eyeballs. They claimed that the old rules of economics didn't apply to the new economy. The NASDAQ composite rose nearly sevenfold. It was mass hysteria. But as we know from history, the higher the valuation, the harder the fall. When the bubble burst, the NASDAQ lost nearly 80% of its value. Trillions evaporated. The internet did change the world, but the companies that were overpriced didn't survive to see it. The housing myth, 2008. In 2008, the valuation lie was different. It wasn't new economy, it was house prices never fall. This belief was so ingrained that the entire global financial system's risk models assumed that home prices nationally could not decline. Rating agencies gave AAA ratings to toxic waste because their computer models said a nationwide crash was impossible. Home prices doubled between 1998 and 2006, far outpacing inflation and wages. When you see an asset class where people say, you can't lose money, run. That is the sound of a bubble reaching its peak. The third precursor is the psychological and political fuel that keeps the fire burning. It is the combination of behavioral euphoria and policy complicity, irrational exuberance. In 1996, Alan Greenspan, the chairman of the Federal Reserve, famously warned of irrational exuberance in the stock market. He saw the bubble forming, but he did nothing to stop it. In fact, the market rallied for another 3 years. Euphoria is when the fear of missing out, FOMO, overrides the fear of losing money. It's when your taxi driver gives you stock tips, 1929. It's when people quit their jobs to day trade tech stocks, 2000. It's when strippers in Miami own 5 investment condos with zero money down, 2008. This behavioral shift creates a herd mentality. Even smart investors are forced to participate because staying on the sidelines looks like losing. As Isaac Newton said after losing his fortune in the South Sea bubble, "I can calculate the motions of heavenly bodies, but not the madness of men." The central bank's role. But euphoria doesn't happen in a vacuum. It is fueled by policy complicity. In every major bubble, the central bank plays a key role by keeping money too cheap for too long. 1920s. The Federal Reserve kept rates low to help Great Britain return to the gold standard. This cheap credit fueled the stock market speculation. 2000s. The Fed slashed rates after the dot-com crash in 9/11, creating the cheap money that inflated the housing bubble. 2020s. In response to the pandemic, central banks printed trillions and held rates at zero, inflating the everything bubble. Central banks are trapped. If they raise rates to stop the bubble, they cause a recession. If they keep rates low, they inflate the bubble until it bursts on its own. Historically, they almost always choose to let the bubble run, hoping they can clean up the mess later. This is the Fed put, the belief that the government will always bail out the market. This belief encourages even more reckless behavior, moral hazard. We have the 3 ingredients: leverage, overvaluation, and euphoria. Now we just need a spark. History shows that the specific trigger doesn't matter. It is never the cause of the crash. It is just the pin that pricks the bubble. 1929, it was a tightening of credit and a faltering in the real economy. 1987, Black Monday. It was a technical glitch involving portfolio insurance, automated trading programs that sold futures when the market dropped. It turned a small decline into a 22% single-day crash. 2008, it was the default of subprime mortgages. When borrowers started missing payments, the complex derivatives built on top of them, CDOs, turned into toxic waste. Liquidity vanished because banks stopped trusting each other. The liquidity crisis. The most terrifying part of a crash is the liquidity crisis. In a normal market, you can always sell if you lower the price. In a crash, there are no buyers at any price. In 2008, the repo market, the plumbing of the financial system, froze. Banks wouldn't lend to banks. The blood flow of the economy stopped. This is when the central banks step in as the lender of last resort, printing money to prevent total civilization collapse. But each time they do this, they plant the seeds for the next bigger crisis. So, where do we stand today? If we apply the lessons of 1929, 2000, and 2008 to the present, the picture is alarming. Leverage. Global debt is over $300 trillion. Governments are running wartime deficits in peacetime. Corporate debt is at record highs. The system is saturated with debt. Valuation. Stock market concentration is at historic highs. A handful of tech companies hold up the entire index. Valuations in many sectors are detached from historical norms, justified by the promise of AI and future tech. Euphoria, policy. We have seen meme stock manias, crypto booms, and a belief that the Fed can engineer a soft landing. We have lived through a decade of zero interest rates that distorted the price of everything. The paradox of policy success suggests that the long period of stability we enjoyed, interrupted only by the pandemic stimulus, has allowed fragility to build up in the shadows. The shadow banking system, unregulated lending, is larger than ever. The derivatives market is estimated in the quadrillions. We are seeing the classic signs of the Cantillon effect, where money printing enriches the asset holders first, leaving the working class behind, fueling inequality and social unrest, another common precursor to systemic change. The 1929 crash taught us that stocks can fall 90%. The 2008 crisis taught us that the banking system itself can fail. The history of money is a history of confidence games. Markets are not machines. They are collections of human psychology. And human nature does not change. We oscillate between fear and greed. We convince ourselves that this time is different. We build pyramids of debt reaching for the sky, and we are always surprised when gravity asserts itself. The warning signs, leverage, overvaluation, euphoria, are not broken gauges. They are the pulse of a system heading toward an arrhythmia. You cannot stop the cycle, but you can prepare for it. You can understand that real wealth is not paper profits in a bubble, but tangible value, resilience, and knowledge. The crash is the transfer of wealth from the leverage to the liquid, from the unaware to the prepared. This is the financial coin historian. History has given us the blueprint. The storm is coming. Are you ready?